Good morning, ladies and gentlemen. Well, by my calculations, we have now swung to positive 10 on the wrist dial. So this is the first time in several weeks that we are in positive territory. It has surprised me, but it is what it is. I am obviously wrong on certain aspects of my analysis in macro, and we'll go now through the bonds and see what the likeliest course forward is. As far as the yield curve is concerned, and this is 2s10s, I mean, it's a very powerful trend lower. What is the lowest that it's ever traded here in the past couple of years? Well, it's around the 10 area, and we closed the week at 2021. It seems that there is very little doubt that we will try to break these lower levels and go even negative. That really would not surprise at all. The Fed has said what it has, that the economy is the strongest that it's been for a long time, and that they will continue raising rates. I see no alternative to a negative yield curve in the short time frame. Every other part of the yield curve is flattening too. This is a weekly chart of 5s 30s, and you can see that the previous high was around 20 basis points on a closing basis. It looks like we're going to break it. If we have a look at this is 10s 30s, we can see that there's here resistance at 24 basis points, and after that we are going to 11 basis points. The trend is unmistakable for a continuation of the flattening, and even 5s 10s, here we are through the previous highs, and we are at zero. So, a little bit of hesitation maybe, but it looks definitely like the yield curve is going to invert. An inverted yield curve eventually signals recession, but the only part of the yield curve which really signals recession is an inversion between 3 months and 10 years. That is the one that is still steepening, because the Fed is so far behind the curve. And I've included a link to what Yardeni says about that in the sheet, in the summary sheet, which you'll be able to read at the end. The charts of the individual tenures look completely different. This is 5s, and to me, there is absolutely no doubt that any dip in 5s is a buy, and at some stage I really would not be surprised to see at least this 270 area. So if we can get back to 177, I think the odds for doing some fairly sizable put spreads in futures and call spreads in yields is very, very good. Now, if we have a look at 10s, this to me at some stage has to trade around the 260 area, and any dip here also is a buy. 30s looks completely different. It actually did a kind of shooting star on the weeklies, and it indicates more stability, even trading down to this 224 area and then going just like the others. To me, TLT is very, very important. This 127.37 is to me very, very important, and it's going to take a long, long time to break it, I think. And that indicates, it indicates certain amount of support for the longer duration equities like NQ, because if this doesn't break, then we've discounted or breaks very slowly, we've discounted most of what there is to discount in the 30-year. But still, to me, the trend is down eventually. And I just can't get bullish of any part of the outright part of the curve. I can just keep on selling the curve, and I just can keep on selling 5s, 10s, and 30s at different levels. 30s least bearish on, 5s most bearish on. The situation in Europe as far as the yield curve goes is exactly the opposite to the States. The shortest end, and this is the Schatz, this is the 2-year, is the one that's going up least in yield. And I would have thought any move back down here to -49 is going to afford us another opportunity to see the highs. If we have a look at the bubble, that is exactly at the levels that I think it should get to, and where, if it breaks, where does it go? I mean, this is as high as it's been all the way since 2018. It's, if we change that to a weekly chart, we can see how violent the moves have been. And really, if it starts breaking here, we are looking for 27 and then much, much higher. To me, there's very little doubt that this still goes higher. In the bunds, we are through all the major levels, and if we change that to a weekly chart, what does that tell us? That tells us that really we are going to trade around these levels at least, which is 66 basis points, and if not quite a bit higher, around the 87 basis points. To me, these are given that we trade around those levels. To give us the timing, the clearest chart is the French market. It is just basically saying not yet. This is the oats, and really while it stays below 89 basis points, I think that the timing, what it's saying is that we're more likely to trade down here. What is that? That is 61 basis points, and then go. These are the opportunities that we're looking for. We're looking for the retracement here and then going. If we change that to a weekly chart, that'll show you what the potential here is. I would have thought the potential is going to be at least 130 basis points, and then probably, that's 130 basis points, and this is around the 110 basis points. So these moves back are going to give us an opportunity for at least a 50 basis point move. The differential between the bunds and the 10-year note is stubbornly stuck in a very, very small, 10-15 basis point range, which says two things. It says that whichever market goes first, i.e. 10s or bunds, it'll retrace, it'll come back to these kind of levels. And secondly, it says that the movement in the dollar cannot really be all that pronounced at the moment, unless we start breaking these levels and we actually expand the volatility in the differential. I still think that we are more likely to break down, because if inflation exists, it exists on a global basis. It doesn't exist just in the US. But we shall see. While this remains in such a narrow range, why should the dollar really move that much? And as we speak of the dollar, really the movement has been minimal over the course of the week. I know that you certainly read Brent's piece about how the dollar tends to weaken after the first Fed hike, i.e., buy the rumor, sell the fact. I am not so convinced that that makes sense at the moment, apart from a very short-term technical kind of trade. Yes, we have come off from the best levels here. Let's enlarge this chart. We were here when the Fed hiked, and we ended up, it's not a million miles away. The trend is still very much up, and I think if you see 96.47 or anything close to it, you have to get out of the short dollar trade. It just doesn't make a lot of sense to me that while the interest rate differentials are stuck, and really probably the timing of Fed hikes is actually going to accelerate relative to the to what the ECB is promising at the very least, that doesn't presage at some stage a higher dollar. So if we go back and have a look at a weekly chart, at some stage I would have thought that the trade has to be to see these higher levels around the 100 area, between 99 and 100 something. That to me makes more sense than the dollar now breaking down. Why would it break down? The interest rate differentials are not suggesting it, and there really is not a lot. The U.S. economy is certainly better than the European economy, and all the risks are in Europe as opposed to in the U.S. So why it should really break down, it's counterintuitive to me. I would have thought any kind of move back down to these kind of levels, what's that, 97-ish, just below 97, you have to cover. I've actually been very disappointed how gold traded last week. It's not so much where it got to, but the look that it's giving. If we enlarge this weekly chart right here, we'll see that basically this is failure. And really, I got long just north of 1,900, and I actually bailed it out on Friday when we couldn't break 1940 and hold 1940. I sold most of it in the 1930s. Not because I think gold should go down, but because the technical look that it's giving me on the weeklies is not the best. If we enlarge the daily chart, and really the only part that we're interested in is here, I think the chances of us trading 1881 are pretty high. And really, even the chances of trading this 1830 level, where the 200-day moving average is, are also pretty high. If we do some kind of an ABC down here, that will be it. Why am I disappointed? I'm disappointed because if bonds aren't going higher in yield, and if and which they didn't last week, really, and I'm talking about the long bonds, and if the dollar is weakening, even technically, why didn't gold do better? We have, we have inflation, we have all the mix that gold should like, and yet it did quite a pathetic little bounce here, and that's it. So something is not right with gold. Whether it's fear of the Russians selling it or whatever it is, I don't know. But it's really a look that says that at some stage we even come down to 1830. It's not something that makes sense to me, but really being long of something which has such a pathetic little bounce is not right either. When will I know that I'm wrong? Really, it needs to start closing well above 1959 for me to start getting even remotely bullish of gold. Gold DBC very much still in a downtrend. This is, don't forget, a daily chart and very much in a downtrend, but very close to reaching levels which make sense to swap DBC for gold. I don't have any DBC left because I was stupid and I got out at 24.39, which now is support. It's supporting very well. We got to it last week and it bounced again. So I don't know what to say. We're so far overbought in DBC on all sorts of time frames. What is interesting, and I'll show this for people who are, who are longer term players, and this is the chart that I wanted to show you. This is DBA over DBC. DBA is really the agricultural inflation kind of commodities. It's a problematic ETF because it has such a contango in it that you keep on losing money because it keeps on buying wheat and things like that, which have a very strong negative yield curve. So it keeps on losing money on the carry. But it's at the lowest levels it's ever been since it came out in 2007 or 2006. So the ratio would suggest that at some stage we have, if this is going to mean revert, it suggests that the agricultural commodities at some stage are going to perform better than really DBC, which is mainly oil. Would make some fundamental sense. And that is for people who are, are looking 1-2 years out, maybe swapping some DBC into DBA here makes sense for the longer term. I'm doing a tiny amount. I'm just not convinced of it. Basically, probably what it does say is that if you want to do something here, maybe you should buy some fertilizer equities rather than anything else. Anything which is connected to agriculture, maybe something like John Deere or things like that. It's some company which is involved in wheat trading and things like that. That is the kind of thing that this chart would say to me, rather than buy DBA, because I keep on saying DBA is a problematic ETF, but it still gives you a good idea that things to do with agriculture are now relatively cheap. And let's start the equity review with the Blue Angels. They are still very much pointing upwards. Earnings expectations are still going higher. The only question that we have to answer is what is the right multiple? And really the right multiple is going to be determined by bonds. And if bonds stabilize, then we are still going to keep on coming up to at least where we were here. And let's see if I can enlarge this part. And, we are going to test this level here again. And what is that level where we top there? Well, that is the 45.80s, that we tested. I very much doubt that the market can go through there, simply because we're too far, up in terms of multiplier, and I really don't see that bonds can come down in yield. I think they can go up less in yield than other parts of the curve, but at some stage I think that the Fed is going to have to start accelerating and doing 50s as opposed to 25s, and that'll be another time when we have a bit of a a growth scare and come back down. As far as next week is concerned, I fully expect us to trade higher, and I'll examine that now. So let's start with a weekly chart of SPX. And it was very much a, sell the rumor, buy the fact of a Fed hike. What does that tell me? It tells me that 45.35 trades, and possibly even 45.94. I would be very surprised if we go through it. Very surprised indeed, because as I showed you, the Blue Angel multiples I don't think justify trading any higher, but I think that the market has got a bit between its teeth and it'll go there. If we switch that to a daily, we are right at the top of the Bollinger Bands, and a couple of days of trading a little bit higher, and then it'll have room to adjust. I just think that we are in a very, very large range, and that we see the top and bottom of those ranges several times over the course of the next several weeks. This market is still not overbought, and that is why I keep on not selling it. I think you want to see it getting to overbought levels before you do anything. I think this is a technical market now. And you really don't want to do anything until the market gets technically overbought. If we change that for a 195 minute, this worked very well in terms of ABC projections, and I think that this will work very well in terms of 195-minute projections, and it's showing that it will get into the sort of high 4500s. So let's be very, very patient here. I would have thought that the odds of trading 45.37 are very, very high, and let's at least wait for 45.37 to get in the least bearish. You can see even here that the RSIs are yet not overbought. Let's give it time and let's allow it to get overbought. The cleanest chart that I have, and I'll, it really has nothing until these levels, and that is, 45, 35s, 45, 40s, if not a little bit higher. People are obviously caught. We are not in overbought territory. We are just in neutral territory. People are going to get caught, are caught, and they are scrambling. We could easily get to these levels where we traded so many times, which is the 45.90s. Patience. For several days last week, I told you that volatility should come down, and every time that volatility comes down, you get the market being bid. And, there's just no point in fighting it until it gets to levels that are worth fighting it. What level is worth fighting? Well, around this 20 area. you can see that every time it's come down through 30 after a spike, it's come back down to at least these 20 levels, if not slightly below 20. Let's enlarge this. And, it basically says these kind of levels, which are 19s, are worth doing. We have a gap down here where we close, which is around 1980, okay? So that is the kind of level that I would expect it to trade in the next 5 to 10 days. And then, lo and behold, we have a gap back up here at 35. What does this chart suggest? This chart suggests we test the upper levels of the ranges, and then for whatever reason there's another panic and we go back up to the 35s. The ideal way to play it is the idea that I gave you of the 1x2 calendar put spreads, and I'll keep on updating it as the short-term technicals change, and I'll keep on changing the exact end dates and the exact strikes, because to me this chart says we trade in the sort of 19s, 18s, and then we double. So that is the kind of interesting trades that we will have in the next couple of weeks. How far can NQ go? Well, it can easily go to this kind of level, which is just short of 15,000 or 15,000. Quite easily it can go to that level. We still have a very small gap here, just above 15,000, 15,064 on a closing basis there. Very, very easily could we go there within the next 5 to 10 trading days, and then the larger trend should reassert itself. People are not long, okay? People are just not long. There are various degrees of short, I would say, and they are caught. Don't try to get short too soon. It's not gonna pay. For anyone that thinks that recession in the US can happen soon, I would point you to the transports chart. Does this look like a chart that is predicting imminent recession? I don't think so. This is a chart which is, if anything, going to new highs. And that is why I have a very tough time believing that bonds can do anything but go up in yield eventually, and that the Fed is going to have to do more than people expect it to do. And that is why I think that equities are really not going anywhere, because they will be tethered to a multiple on the Blue Angels, which is around times 18, times 19, whatever it is. But it's not, it can't go a million miles higher. We cannot expect a roaring economy if the Fed is having to hike rates more than is expected. That means that at some stage we will have a growth scare, and that is in the summary sheet. The link to that is in the summary sheet that I always do at the end. Something very, very unique happened last week in EM, and let's enlarge it. And I was quite amazed. This is a key reversal weekly. Okay, it opened below the previous close, it went down right to the 0.618 retracement of the whole move and closed through the highs of the previous week and basically did a key reversal. This is a key reversal weekly. A key reversal on the weeklies, if we just enlarge this a little bit better, basically suggests that it returns to where it came from. it came from around these levels, right around 50 to 52. I would have thought that this suggests that we go back to 50 to 52, and that is a 10% move. So that's what this is saying. We are going back to a 10% move. We can get rid of this. A 10% move here, I would have thought that if we have a look at the EEM spreads, would give you at least, and this is against the US, okay, so it goes up here, it would give you at least a 3% move in US, so that's 120 from where we close, and that also matches, the high 4500s that we were talking about earlier in the S&Ps. All the other charts, like Nikkei and also Europe, which we'll see in a second, are basically saying the same thing. We closed back above 26,910. I would expect the bounce to go here, 28,335. Here we have 28,180. This is going to be very, very key. You can see all the weekly moving averages turning over. A quick bounce to these kind of levels, and then we see the most interesting one to me is the stocks, and that's actually the wrong one. This is a better one to look at. These levels seem to be working very, very. I got incredibly lucky at 3,381. It traded 3,380 on the low. And here it kept on bouncing off 3,844 last week. I would have thought a quick bounce all the way up to 3,986. And then it'll be probably in a position to start coming off. To me, Europe is the one that makes least sense to be long of. I know that the war will end, but I just don't see that the problems in Europe are going to get any less. I can only see them being exacerbated oil prices are not really going to come down that much, and as soon as the threat of further recession is out of the way, all this market has to look forward to is some kind of normalization by the ECB. And it's, just really the weakest market. So to me, it just makes no sense to even want to equal weight Europe, let alone overweigh it. To me, other markets make a lot more sense, but it's still not going to stop it trading 3,986 next week, I don't think. I've updated all the levels, and I think the opportunities next week are going to be on retracements in fives, both in Europe and in the US. That will be the interesting trade to put on, so looking for higher yields once they retrace to those levels. And this is the link to what Yardeni thinks, and I very much also agree with him. It's an interesting read, it's a short read, so please have a look at it. All the other levels are updated, and I think that we let the S&Ps run before we do any bearish trades, as I said. And also, I'm quite convinced that we're going to see all the targets that I've put in the NDX and EEM and the stocks met next week, and those will be interesting levels to do some trades there as well. Thank you very much indeed, and tweet you tomorrow.